Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Matt Bartolini, Head of Spider Americas Research at State Street Global Advisors. We're talking about the market outlook and some ETF ideas for the second quarter. Matt, welcome back. Great to have you on the show.
Yeah, great to be back. Thank you for having me.
So the first quarter has been quite a roller coaster ride for investors, with worries about rising inflation, tighter monetary policy, and lately the impacts of the Russia-Ukraine war weighing on investor sentiment. And the S&P 500 index, in fact, has had an impressive rebound over the past few days. And for the purpose of reference, we're talking on March 23rd. In fact, last week was the best week for major indexes since November 2020, but the S&P 500 index is still down a little more than 7% for the year. So I wanted to start with your thoughts on the recent market action.
Yeah, so we're trying to decompose the returns by what might be driving what the S&P 500 and the broader market higher. We can take a factor lens to it, so looking at different attributes. And what we actually find over the last 5 days, it's been high beta, so high risk stocks with low quality aspects, so ones with maybe negative returns on equity or highly volatile cash flows. It has also been firms that are highly levered, so a high amount of debt to equity on their books. But then also it's been the losers. So it's been the worst performing stocks over the last 12 months. So it was a little bit of like a trash rally, so to speak, in the last 5 days or so, which again, very nice to see. If the markets are down 6-7%, you start to have a comeback as a result of that. But it's one of those rallies that doesn't seem wholly sustainable on the trajectory that it was on in those past 5 days. It's a pretty sizable bump in equity values. So that gives us a bit of a pause around sort of the sustainability of that most recent 5 to 7 day run, and what that might mean for further on down the road. And sort of one of the only certainties right now is that we're going to be investing and existing in a pretty volatile environment. We think it's the return of episodic volatility, which really means that headline risk is going to be driving some of the market action. And it's going to obviously take place with what's going on in Ukraine and the war there, but also what the Federal Reserve is doing and the policies that they're going to be implementing, but also what other central banks around the globe are doing, particularly the Bank of England and the ECB.
Interesting. I like the phrase trash rally. So you think the worst is not over for the market. And you talked about uncertainty and volatility, and we know that markets don't like uncertainty. So we have seen these wild swings in the stock market lately. So how should investors prepare for this heightened volatility?
Yeah, and I wouldn't say that I think you said like the worst is yet to come or something from that perspective. It's just that the market is going to be at the whims of volatility right now. If we look at some technical indicators, there's really no significant trend either way. So your day-over-day returns are less correlated to each other. So that really just shows sort of again, episodic volatility, a heightened amount of risk in the marketplace because there's so much uncertainty. And you can kind of see this within, across assets. So equity implied volatility is elevated. Bond volatility is in the 90th percentile historically. High yield credit volatility is elevated, as well as currency volatility. So it's sort of, it is a bit of a fraught time period from an investing perspective. In risk assets, equities, credit are going to be at the whims of these type of macro events. We are likely to see more volatility than less over the next few trading periods. So in terms of like what investors might want to consider is trying to build in some form of defense that doesn't sacrifice so much on the upside. And if we think about this, is that if you're just going to use a minimum volatility ETF, that would have obviously done okay when the markets are drawing down. But given that we do have some upside potential here, and that the market has rallied, and that there is some potential optimism, particularly on the horizon with respect to earnings, you don't want to sacrifice so much of that upside. So taking more of a balanced defensive approach that blends both minimum volatility, but also some other return-seeking factors can help sort of navigate this really episodic volatile period.
So, in a recent note, one of the recommendations you had was this SPDR MSCI USA Strategic Factor ETF. The ticker symbol is QUS. And I'm looking at its top holdings, these high quality companies with the solid balance sheets: Apple, Microsoft, Johnson & Johnson, United Health. These are among the top holdings in this ETF. And you talked about minimum volatility too. So investors were very disappointed in minimum volatility ETF in 2020 because when the market dipped and then there was a sharp rebound in the stock market, minimum volatility ETFs continued to underperform the broader indexes. They did not rebound with the broader indexes. So do you think instead of minimum volatility, this ETF QUS may perform better in the current type of environment when there is no clear direction in the market?
I think it would be more suitable for this current environment because of the lack of a concerted direction. So, one thing that we look at is, the ADX technical indicator, and then there's also the direction market index. And there was a pretty specific downward trend, as the invasion started, which is natural. But since then, that sort of indicator has sort of pointed towards more of a neutral trend. And we've obviously have seen a couple days in a row where returns are greater than 1%. And as we're talking today, stocks are down almost 1%. So I think you're going to continue to see these gyrations. And because you're going to have gyrations, one, being defensive can help, but not so much sacrificing on the downside. So something like QUS, because of its balanced factor exposure, it historically has had lesser downside capture or lesser drawdowns than the S&P 500, but greater upside potential than traditional single factor minimum volatility. And I think, given these market gyrations, that likely could be beneficial for investors seeking to de-risk, but still remain or retain some of that upside.
So you mentioned rising inflation, and I wanted to talk a little bit more about inflation because it is currently at its highest level in about 4 decades. And before the war in Ukraine started, many experts had predicted that inflation would cool off in spring because supply chains were likely to improve after pandemic-driven disruptions. But this conflict has sent prices of energy, oil, natural gas, wheat, industrial metals, and some precious metals to surging. It appears that higher inflation could persist for longer. And the pandemic is also not over yet. We have seen these frequent resurgence of COVID in China, and because they have zero tolerance policy for COVID, so we have seen these renewed lockdowns too, which continue to disrupt global supply chains. So it seems that these inflationary pressures would continue to persist. So tell us what investors should do to hedge their portfolios against rising inflation.
Yeah, so we had the CPI print, which is at 40-year highs, but that CPI number is not really factoring in the recent commodity-induced price increases from the Russia-Ukraine war.
Right. Because that is for the month of February, right? And the war started towards later last week of February or something like that.
That's correct. And also, the producer price index, was recently released for February, and that had a 10% increase year over year. So those numbers can still move higher. And my expectation is that they do. And if we look at break-even inflation rates, the 2-year break-even inflation rate, so basically, what if you own a TIPS security versus a nominal treasury, what you'd have to break even for inflation to be, is about 4.8%. So that's really indicating a significant amount of near-term inflation, not transitory, definitely not transitory, but near-term inflation. I think it's a result of what we're seeing in the Russia-Ukraine war. I think, from an implementation perspective, trying to understand what type of segments of the economy are really tied or have a strong correlation to inflation, as well as inflation expectations. And it's sort of based upon the operating, and profitability of those underlying firms. Natural resource equities are one of those that, obviously they transact in agricultural, industrial metals, energy markets. And as those prices are going higher, the ability for them to then sell those goods at higher prices should materialize into higher earnings, and then therefore, increase profitability, which we've already seen sentiment turn that way. We've seen in Q1 2022 earnings estimates have been revised higher for only 5 sectors, and 2 of those 5 are energy and materials. So you're starting to see some positive fundamental sentiment go that way. And there's precedent for this, because if we regress natural resource equity stock prices versus break-even inflation rates, there's a 70% correlation to those historically. So we've obviously seen break-evens move higher, inflation expectations move higher, and natural resource equities is one way to, participate in this more higher inflationary market environment. You also just, again, have historical precedents. When the 12-month average CPI is in the top quintile in history, which is greater than 3%, and we're definitely there, natural resource equities have outperformed the market by 7.5% on average over the last 15 years. So that's one of the things that we think investors could look at, is looking at natural resource equities, metals and miners. We have ETFs that cover those markets. Natural resource equities would be NANR, and then for metals it would be XME. I think those allow you to take a more fine-tuned allocation into segments and sectors of the economy that have a high historical correlation to inflationary pressures.
You have one more recommendation in your note in terms of implementation ideas. That is the SPIDER Multi-Asset Real Return ETF. The ticker symbol is RLY. And this is a fund of funds, right?
That's correct. It's an actively managed real return strategy that invests in underlying ETFs focused on real assets. So REITs, TIPS, and again, TIPS have done quite well. They're still down on the month, but they're outperforming nominal treasuries by about 4% over the last 3 months and 2% just in this month alone. So it'll own TIPS, it'll own natural resource equities, metals and miners, it'll own commodity ETFs as well. And I think that's really important because natural resource equities, they're up I think 20% since the invasion started, but it hasn't been without volatility. And some of our earlier comments, the realized volatility over the last 60 days, so 60-day realized volatility since the invasion started, is up about 10% for the S&P 500. Natural resource equities, which have vastly outperformed the broader market, have witnessed volatility increase by 26%. And I think this sort of speaks to some of the uncertain market dynamics that are predicating these higher inflationary prints in the near term, which is the Russia-Ukraine war. So I think having a more, if you don't want to take a more precise approach into, say, NANR or XME for natural resource equities and metals and miners, using a strategy that takes more of a multi-asset approach, looking at it from a risk management perspective and an active asset allocation perspective, can help potentially mitigate some of the volatility of some of the underlying specific markets within natural resource equities.
Interesting picks. And I'm looking at the other 2 ETFs and their holdings. So the natural resources ETF, NANR, Chevron, Exxon, Nutrien, these are the top holdings in this ETF. And the metal and mining ETF, the ticker symbol is XME. Steel Dynamic, Alcoa are the top holdings in this ETF. Now let's talk about interest rates. Last week, the Fed raised the interest rates by 25 basis points, and they penciled in 6 more increases by the end of this year. And this was the first interest rate increase by the Fed since 2018. 2015. But Fed Chair Jerome Powell's hawkish comments earlier this week, he was talking about inflation, and that was on Monday. That suggested that they could even raise interest rates by 50 basis points at each of the May and June meetings, and they could, have more than 6 rate hikes this year. So investors are, of course, concerned about rising interest rates. So could you talk about areas which tend to outperform in a rising rate environment, which investors could consider?
Yeah, I mean, I think one of the areas of consideration is on the fixed income side. Floating rate notes or senior loans, and a lot of people usually pay a lot of attention to the fixed income side. We think about rates because everything's just so rates driven. I think on the equity side too, a lot of people should sort of remember, what type of maybe rate exposure they may have within the equity side of the portfolio. And some of the work that we have done is we examined the correlation of different market exposures on the equity side to movements in interest rates, as well as break-even inflation rates, because some of the reasons why the Federal Reserve is now tightening and likely to tighten considerably is because of the inflation dynamics and the ability to control inflation. We heard Powell say that we're going to get inflation under control. So when we look at those correlation structures, we think small caps have a high correlation to interest rates, as well as a high beta exposure, so there's sensitivity to it. Small caps, it's you got to think about it on a relative basis. So small caps relative to large caps. Small caps do have a higher sensitivity to movements in interest rates. The other one is value. So value stocks have a high sensitivity, particularly relative to growth, to movements in interest rates. And I think that's, if we even look at the year-to-date returns this year, value stocks are down, just about 1%. Growth stocks are down 10%. And when we looked at this in months in which interest rates moved higher, the return correlation of growth stocks, excess return to the market, was negative. So as rates move higher, the excess return of growth stocks is negative. For value, it's positive. And that's why we think value stocks could do well in a higher rate environment, as well as small cap stocks. Again, speaking on a relative terms to both large cap and to growth, because of course there's going to be some market exposure to that, so it's not in absolute terms, but in relative. There's also, on a sector level, natural resource equities would do well, just given the inflation dynamics, but also like bank stocks. We've actually noticed, again, we're likely to have a bear flattening of a yield curve, where the long end does not rise as fast as the short end. So we're still getting higher rates. Now, flattening yield curve, people say that constrict bank margins. We've actually seen bank stocks sort of decouple from the yield curve relationship, because net interest margins are mainly are not as tied to it. We've seen still positive net interest margins for bank stocks. And part of that has to do with changing dynamics of the underlying banks themselves, but more profitability for them from a lending perspective in the short end too, because higher rates within the say securities lending and things like that. So if we had sort of ordered the picks in terms of rising rate on your equity side, it'd be value, small caps, then bank stocks.
Interesting. Now, I also wanted to talk about energy and clean energy as well, because crude prices have surged since the war started, and they were surging even before the war, and lately they have surged because of the supply disruptions and geopolitical tensions. And it seems that this war will have a profound impact on the oil and gas market, and it could in fact accelerate the world's transition to clean energy. So energy is the best performing sector year to date. It was the best performing sector last year as well. But lately, over the past week or so, energy stocks are kind of stalling. It seems they are topping out, though they are up today again. And clean energy ETFs have also done very well since the war started, of course, because everyone expects that because of this war and Europe's dependence on Russian oil and gas, probably we will have to see a lot more investments in clean and green energy if the world has to reduce its dependence on Russian oil and gas. So in terms of opportunities, which areas do you like as of now? Your energy ETFs, including XLE and XOP, they have done very well this year. And the clean energy ETF, CNRG, that has done quite well since the war started. So which areas should investors look at now?
Yes, I think it's a bit of a two-sided answer to that. If you're a top-down investor looking at different macro exposures, I think we can understand and conceptualize that oil markets are going to be pretty much elevated, just given what's going on from the market perspective. Like there's going to be somewhat of a floor associated with oil prices. Again, predicting oil prices is a fool's errand, but I think we can at least acknowledge that there's upward pressure on that, particularly what we're even seeing today with Putin saying that hostile countries can pay for Russian gas, but they have to pay in rubles. That's obviously going to have a dynamic on it. So I think something like XOP, if you're looking to say play higher oil, that is an instrument that has a very high sensitivity to the spot price of oil, roughly around 60 to 70 beta to the spot price of oil. Conversely, what is happening is that this is going to accelerate the interest in use of clean energy to wean, particularly European nations off of the reliance on, Russian supplied oil and gas. And as a result of that, we have seen a significant uptick into clean energy ETFs. I think one thing that's interesting is that CNRG is our clean energy ETF. It's actually had stronger performance in the past month versus XOP, which is a little bit antithetical to the intuitive sort of thought that this XOP is mainly oil, while CNRG is focusing on renewables. And I think that just shows sentiment shift that this is going to accelerate some of the innovations within the clean energy markets. I think there's one on a short-term basis that you're going to see from a macro exposure with XOP, but then more longer term, we were already on this trend of having more renewable energy capacity. I think 70% of all electricity is generated by renewable forms in the U.S. last year. Something to that effect. And that's only likely to increase not only in the US, but around the world.
So you also track fund flows very closely. And I was interested in your observations from the recent fund flows. What kind of trends you have seen?
Yeah, so the flow trends, mainly continue to have inflows within ETFs. About Atwards March 23rd, so still the month isn't over. But roughly $63 billion of inflows into ETFs. 40 of that has been into equity, so very equity biased from that perspective. And then within equities, 40 billion, so roughly 92%, has been into U.S. equity exposures. So really, investors are just focusing on the U.S., not really looking to go outside the U.S., particularly given the relationship that Europe has to Russia and the reliance on that from a commodity trading partner. And obviously, from a returns perspective, the U.S. has performed much better than the rest of the world, particularly since the invasion started. So we should see more focus in the U.S. And then within sectors too, there's we've seen a concerted interest into energy materials. Those two sectors lead on the month in terms of asset gathering. And then the third theme has been commodities. So gold-related ETFs have taken over $5 billion. That if the month were to end today, that would be the the sixth most flows ever for gold-related ETFs over the last 15 years. Similarly, broad commodity ETFs have taken over $2 billion. That's the second consecutive month they've had more than $2 billion of inflows. In this month, if it ended today, it would actually be the third most ever. So the big themes is still equity, still sort of risk on, about $12 billion into fixed income, but it's mainly government funds, so it's a little bit of risk off. But then also within equities, focusing on the natural resource, energy materials, and then overlaying that with some commodity exposure as well.
Yeah, commodities is a very interesting area. They have seen massive inflows this year, and you mentioned gold too. And gold was in fact trading more or less sideways last year, but it has been rising of late. And now it is close to its highest level in over a year or so because of this volatility and geopolitical uncertainty. And we know that gold is traditionally seen as a hedge against inflation. So the spike in inflation has also sent some investors into the precious metal. And gold is also probably benefiting from the sell-off in cryptocurrencies because last year, many younger investors had pivoted to Bitcoin and Ether. They called Bitcoin digital gold. So do you think gold still looks attractive? Because once the interest rates have started rising, though real interest rates are still in the negative territory, but rising interest rates in general dim the appeal of gold because they raise the opportunity cost of owning gold. So what is your outlook for gold for the coming months?
Yeah, I mean, so it's hard to, gold has many different drivers of returns. There's fundamental drivers in terms of supply and demand within the, local gold markets for jewelry, and technical and industrial uses. You do have the relationship to the dollar, it has a negative correlation to the dollar. Relationship to interest rates, particularly real interest rates, but then also uncertainty, right? So I always like to say gold has a positive correlation to uncertainty, right? As uncertainty increases, gold prices should likely increase as it's sort of defensive, safe haven, quality type of asset. The sort of expectation, if we frame it from the rates environment, it's helpful to take a look back. During the past Fed tightening cycles, and the last two, 2004 to 2006 and 2015 to 2018, gold actually rose 57% and 17% respectively. So it wouldn't sort of paint in a picture myopically that, interest rates are going up, that must be bad for gold. We have to sort of take a bigger context. We do have higher inflation. Gold does have a store of value. There has been supportive gold demand trends because of the resumption of consumption as it's come out of the pandemic. And then also there's this uncertainty. So I think it still represents an attractive or conducive environment for gold going forward, particularly as that source of diversification within portfolios.
I agree with you. Gold is worth a look, mainly because of its diversification benefits and also as a safe haven asset during times of uncertainty. And the two ETFs that are worth a look are your ETF GLD, which is the largest gold ETF in the world, and that is more suitable for shorter-term trading purpose for investors, longer-term investors who want to invest in gold over the longer term. The cheaper version of GLDM is worth a look. That's all we have time for today. Matt, thank you so much for joining us.
Thank you for having me.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.